to the EBI Policy Series on the ECB's supervisory approach on climate-related and environmental risks. The fact that we have a policy series about such a topic with around 250 people registering for the event on a Monday morning shows how times have changed since the last 5 years. Back then, I would say climate change and supervision would probably not have appeared in a footnote of a very specialized article about supervision, if at all. And now we have the key supervisor in Europe, the SSM, developing guidelines for banks on how they shall manage and disclose climate-related risks. It will perform another thematic review on this topic at the beginning of this year, and also a first stress test on climate and environmental risks, with a specific risk scenarios already being published. An astonishing development for sure. And I'm very happy to welcome in this regard Frank Elderson, who is a member of the executive board of the ECB and who has been key to drive forward this topic in the supervisory community, both in his previous role in the DNB and now at the ECB and the Network for Greening the Financial System. Welcome, Frank, and thanks for participating at this event. I also would like to welcome Eila Kreivi from the EIB, the European Investment Bank, and Professor Moslener from the Frankfurt School of Finance, a member of the EBI, both co-discussants very much involved in this topic, sustainable finance, from a practical and academic perspective. I will introduce the speakers in more detail in a minute. The last years have shown that protection of climate and the environment is a task for society as a whole, and not only specific actors. Frank has always said in one of his speeches that central bankers and supervisors should always be mindful of the circumstances in which they will pursue their tasks and fulfill their responsibilities in the years to come. From this starting point, the ECB has developed its own approach on climate and environmental risks. The ECB and the SSM are not just bystanders, but have to act within their mandate in order to ask banks to address the risks coming from these challenges. We are very keen to hear more about the ECB approach on this topic. Now, let me now quickly introduce Frank and the co-discussants in more detail. First of all, Frank Elderson is a member of the Executive Board and Vice Chair of the Supervisory Board of the ECB. Before that, he was Executive Director of Supervision at the Netherlands Bank, DNB, and he was also one of the precursors in the creation of the Network for Greening the Financial System, which connects more than 80, I think now more than 100 central banks, I have to correct myself, and financial supervisors, and aims to accelerate the development of green finance worldwide. He studied law at the University of Amsterdam and holds an LLM degree from Columbia Law School. Thanks again, Frank, for participating. Then moving on to Eila Kreivi. She is Chief Sustainable Finance Advisor at the European Investment Bank. Before that, she spent 11 years as the head of capital markets, also at the EIB. She has extensive experience in the field of sustainable finance and has been deeply involved with the EU Sustainable Finance Action Plan. Eila was also an alternative member of the European Investment Fund. And last but not least, Professor Dr. Ulf Moslener is a professor of sustainable energy finance at the faculty of the Frankfurt School of Finance and Management. He's also a scientific director at the Frankfurt School UNEP Collaborating Center for Climate and Sustainable Energy Finance. His research fields include the economics of climate change, sustainable finance, and climate finance. He's a graduate physicist and did his doctorate in environmental economics in the graduate program of the University of Heidelberg and Mannheim. I think, Wolf, that's a primer that we have a physicist at the EBI, so welcome here also from our side. We start with a keynote speech from Frank Elderson, who I would hand over now the podium. Thanks again for coming, Frank, and over to you.
Well, thank you very much, Professor, and thank you very much to all the organizer of this event, and indeed also for the audience for this Monday morning event, as you so aptly pointed out already. Some years ago, Andrea and Ria, my colleague and the chair of the supervisory board, gave a speech precisely at EBI conference, calling for greater transparency in prudential supervision. And when describing the role of transparency and information disclosure, he echoed the words of a US Supreme Court Justice, Louise Brandeis, who said, "Sunlight is said to be the best of disinfectants, electric light the most efficient policeman." And this couldn't be truer for climate-related disclosures. As I have said before, when discussing the supervision and prominence of climate-related and environmental, or C&E, risks, we can only tackle the problem once we get a good grip on its shape and size. Some information may be uncomfortable to face up to, but bringing it to light is the first step in making progress. When it comes to climate change, the information on what Al Gore famously dubbed as an inconvenient truth is indeed getting bleaker by the day. The most recent IPCC report confirms the dramatic consequences of not taking immediate action. Additional global warming of up to 1.5 degrees Celsius in the near term would increase climate hazards and present numerous risks to ecosystems and human society. Europe, in particular, is badly affected as temperatures here continue to rise above the mean. And despite our efforts to reduce CO2 emissions, we lag far behind in terms of what we need to do to adapt to some of the inevitable consequences. It is time we face the facts as citizens, as institutions, and as all actors in the economy, including, of course, banks. It is essential that banks share with their stakeholders detailed information on their exposures to C&E risks. Only then we can all effectively work together to address the consequences of climate change. And this is why today I would like to draw your attention to another important landmark in the ECB supervision of climate and environmental risks, the publication of our second stock take on the transparency of banks' disclosures of their C&E risk profiles. Publishing this update is part of our supervisory agenda on climate. As you know, C&E risks have been one of our supervisory priorities for some years now, and we have started treating them just like any other prudential risk. In this context, we have been rolling out a series of corresponding supervisory activities. In 2020, we published our guide on climate-related and environmental risks, which outlined our supervisory expectations relating to the management and disclosure of C&E risks. In 2021, we published a self-assessment benchmarking report. And in 2022, we launched a climate risk stress test and a thematic review on how banks incorporate C&E risks into their processes, a fully fledged supervisory exercise involving teams responsible for the day-to-day supervision of banks, the joint supervisory teams. And at the same time, we are gradually integrating C&E risks into our regular supervisory methodology, and how banks manage these risks will ultimately impact their Pillar 2 capital requirements. The ECB's supervisory actions on climate are part of a broader international effort to advance the supervision and regulation of C&E risks. At a global level, the Basel Committee on Banking Supervision recently concluded a public consultation on draft supervisory principles for the prudential treatment of climate-related risks, and the input they received is now being reviewed with the aim of finalizing these supervisory principles. This is part of a broader work plan of the Basel Committee to evaluate how to consider climate-related financial risks in all pillars of the Basel framework: supervision, regulation, and the topic of the ECB report that is published this morning, disclosures. There is growing international awareness of the great value of transparent disclosures. Disclosures that are clear and easy to understand tend to benefit any company, banks included. Generally, companies have strong incentives to publish frank and meaningful disclosures because transparency is usually rewarded by investors. It helps reduce uncertainty and allows all interested parties to feel that they are making safe investments based on trustworthy data. This is particularly true for climate-related and environmental risks. As the materiality of physical and transition risks increases by the day, investors are on the lookout for those companies that proactively take these risks into account in their daily operations and across all their activities. One of the essential functions of financial markets is to price risk and thus support informed and efficient capital allocation decisions. The accurate and timely disclosure of current and past operating and financial results is central to that function. And to make it more concrete, the more transparent banks are about their C&E risk profiles and their concrete efforts to align their portfolios with the Paris Agreement, the easier it is for market participants to compare banks, to reward those which are taking the necessary steps to adopt risk management practices aligned with a carbon neutral economy, and to re-evaluate those with misaligned trajectories. Transparent disclosures also create a certain level of peer and stakeholder pressure, which is essential to making companies properly manage these risks. Investors and asset managers are seeking to develop and market portfolios that are aligned with the sustainable objectives of their clients. As such, they are becoming increasingly demanding about corporate C&E disclosures. Banks' own shareholders are becoming increasingly demanding too, especially concerning banks that have publicly committed to achieving net zero targets. In fact, failure to disclose meaningful follow-up information on their climate commitments has actually already led to significant litigation and given rise to heightened reputational and legal risks for some banks. Recent regulatory and legislative initiatives reflect growing international awareness of the great value of transparent disclosures on C&E risks. In Europe, large banks will have to disclose climate-related information under the European Banking Authority's comprehensive implementing technical standards. They will have to already do so by early 2023, referencing data from the end of 2022. And the information requested from banks includes qualitative and quantitative information on environmental, social, and governance risks, as well as indicators such as alignment metrics and the green asset ratio, thus significantly raising the bar in terms of C&E risk reporting. In the same vein, sustainability reporting obligations under the European Commission's Corporate Sustainability Reporting Directive will shortly apply to large corporations, including banks, under our direct supervision. Now, the ECB is also well aware of the importance of transparent disclosures. We published our first stock take of banks' C&E disclosures back in November 2020. And we did so precisely to give banks the time and the incentive to improve the quality of their own disclosures in this field. Back then, virtually none of the institutions in the scope of the assessment met our expectations, as set out in the ECB Guide on Climate-Related and Environmental Risks, which we published back then at the same time. Now, the second stock take, the one we published today, shows that the quality of banks' disclosures has improved since then, especially in the areas of risk management, governance, and business models. However, this improvement has only been marginal. As of 2021, 7 in 10 banks disclosed information about C&E risk management and governance, compared to 5 in 10 in 2020. While only 4 in 10 shared relevant information about the incorporation of C&E risks into their strategic considerations, up from 3 in 10 in 2020. And all in all, none of the 115 banks directly supervised by the ECB fully meets our supervisory expectations for disclosures. Now, there is very little justification for this lack of substantial progress, particularly considering the vast amount and quality of climate-related data, tools, and information shared by different international and European organizations and institutions in recent years. The sheer speed at which regulations and metrics are developing in this field should leave no room for any doubt. Addressing climate-related and environmental risks and publishing good quality disclosures is not and must do much better to improve the quality of their disclosures, and they need to do so quickly. However, we see a considerable disconnect between banks' perception of the importance of C&E risks as communicated to us, the supervisor, and what banks choose to publicly disclose. Banks are trying to compensate for the poor quality of their disclosures by issuing a great volume of information around green topics. And we end up with a lot of white noise and no real substance on what both markets and supervisors really want to know. How exposed is a bank to C&E risks, and what is it doing to manage that exposure? It is, of course, relevant for banks to publicize their efforts to, for example, reduce the electricity consumption of their branches. However, it would, of course, be much more significant if they were to announce how they are steering their activities towards risk management practices that are aligned with a carbon neutral economy. Looking at the world through green-colored glasses is not quite the same as a sound management of all material C&E risks. We also observe a lack of concrete detail in how banks substantiate their climate-related and environmental metrics and targets. For example, when reporting on their commitment to align with the Paris Agreement, only around 1 in 5 institutions disclose the methodologies, definitions, and criteria for all of the figures, metrics, and targets reported as material. More than 1/3 of institutions do not disclose these aspects at all. And in light of the increasing importance of such commitments, interested parties will increasingly seek information on these alignment metrics, and banks' disclosures must become meaningful in this regard. Now, there are best practices. Like many other institutions and agencies, the ECB is committed to sharing the best practices that we have found across the industry. Not only do they serve as inspiration for banks who need to catch up, they also show that the ECB's expectations can, in fact, be met. For example, one of the banks, under our direct supervision, published its own climate strategy, which aims at achieving net zero emissions for its lending portfolio by 2050 or sooner, in tandem with a number of interim targets and related metrics, as well as the progress made in meeting them. For each of these targets and metrics, the bank discloses the sectors covered, the underlying methodology, and the scenarios used to draw up benchmarks. For the methodologies and scenarios, it reports on the options it chose, the data sources it used, and the changes it made with respect to the previous disclosure. Another example of a good practice or a best practice, another bank endeavored to align its portfolios with science-based transition pathways, including technology pathways originating from the International Energy Agency's Net Zero by 2050 report. The bank disclosed dashboards that display the performance of its loan books in various transition sectors, such as power generation, oil and gas, automotive, steel, cement, and real estate, against a science-based transition pathway. It also disclosed the precise indicators used, the underlying methodologies, and the reference scenarios for each indicator. For each of the indicators, the bank then disclosed its current and projected performance against the pathway and the set associated targets. Importantly, many of the banks raising the bar in C&E disclosures are small and medium-sized, showing that remarkable progress is achievable by all. Now, let me now outline the next steps that the ECB plans to take to follow up on the results of our assessment of banks' C&E disclosures. What we have done is send individual feedback letters to all banks under our direct supervision, setting out the key gaps in their disclosures and conveying our explicit expectation that they will take decisive action to address these gaps. In doing so, the banks will ultimately ensure that their risk profile is transparently and comprehensively reflected in the information that they disclose to the public. Addressing such gaps will also mean banks are well prepared to meet impending technical requirements. And as I mentioned, the consequences of non-compliance with minimum transparency standards are only going to increase for the banks, as legal and reputational risks are starting to materialize for banks which fail to step up the quality of their disclosures. More and more clients, investors, and other market participants want meaningful and comprehensive information on the climate-related actions of their banks. And that way, they can make conscious, informed decisions about where their money goes. Moreover, failing to disclose exposure to risks, including C&E risks, constitutes a breach of the Capital Requirements Regulation. As such, we stand ready to use the full array of supervisory tools at our disposal to ensure bank C&E disclosures are up to our standards, and ultimately that eligible banks are prepared for the new regulatory requirements. The ECB, in addition, publishes a yearly report on banks' Pillar 3 disclosures, where we also have the option to publicly list those banks which repeatedly fail to disclose their C&E risks. In view of the poor results shown by our stock take. And to assess the extent to which the banks address individual feedback, C&E risk disclosures will continue to feature prominently in the ECB supervision. And we will assess banks' C&E disclosures again at the end of 2022, and we expect to see major progress by then. Let me conclude. Stricter disclosure regulation is underway, and time is running out for banks to get ready. 5 years have passed since the Task Force on Climate-Related Financial Disclosures published its recommendations. There are also many initiatives, some of them open source, to support banks' efforts. Many companies have improved their disclosures and now provide information that can feed into banks' own disclosures indicators. And for those banks that have systematically fallen behind the ECB's and the market's expectations, there is only one way forward. It is time for banks to be transparent and comprehensive with their C&E disclosures, so that by bringing them to light, we can progress from an inconvenient truth towards a much desirable outcome for us and for all future generations. So let me end where I started. The first step to coming to grips with any inconvenient truth is full disclosure. Thank you.
Thank you very much, Frank, for this very interesting presentation with a strong demand by the ECB for a higher level of disclosure by the banks. You mentioned in your speech that there wasn't a lot of progress made by the banks since the last report on disclosure by the ECB. And before I hand over to the co-discussants, maybe one short question. Do you have any view why the banks have not made progress in the way that you hoped for or expected it to be? Is it because they are busy with so many other topics, or is just C&E risk not on the right level of priority for them so far? Do you have any view which you're getting out of your feedback from the banks?
Well, thanks for this question, Thomas. I would say that very briefly, the banks that have done their homework, they see that this is relevant, that this is material. And those who say that they think that this is actually not so material, they either have not done their homework or they haven't done it well. So it's relevant, and I think that the awareness has, of course, been growing progressively, and speeches like the one I just gave are also intended to in those quarters where that awareness maybe is not yet at the right level to raise that. I also made the point that there's now lots of information available. So just looking back and continuing to say what maybe 2-3 years ago was still very relevant is increasingly becoming less relevant. When I say doing homework, it means that you realize as a bank and that you actually go painstakingly through what is the information that you need. So even if there's information gaps, if there's data gaps, at least you know what is the information that you would need. And not all banks have gone through that. And those that have, not all have then formulated key performance indicators. So yes, there is progress. There are good practices. That's also a point that I think is very important to make. Our expectations are being met. So it can be met, but not by all banks and not all expectations by all banks. But the good news is that it is possible. It is possible across business models. It's possible across sizes of banks, across jurisdictions.
Thanks very much, Frank, for this answer. Let me now bring in Eila Kreivi, who is the Chief Sustainable Finance Advisor at the European Investment Bank. Has a lot of experience in this topic, and I would hand over to you, Eila, for your short reply to Frank's speech.
Okay, thank you. Yes, I do have indeed plenty of experience, but I have to put a disclaimer here, not as a risk manager, though, but good morning and thank you, EBI, for this invitation. Can I get the slides? Okay, we can go directly to the second one. So I'll just touch upon a couple of aspects here in the interest of time. EIB and climate action, EIB's climate bank roadmap is a big theme. I could talk about it for the rest of the day. But we have been doing this for a long time. We have started climate action when we put it as a top priority, one of the top priorities of the bank already 15 years ago. So it's not exactly a new thing for us. What is more recent, though, is talk about adaptation finance. And this was, for example, one of the main commitments that we made in Glasgow to increase substantially our financing for climate change adaptation, i.e. resilience for the damages that are already done. We have also been attaching a lot of importance in measuring the impact of the financing that we do. So not just the, I lost the last slides, by the way, not just the billions of financing that go, but what is the impact? So we have been measuring, for example, the carbon emissions saved, both in relative and absolute terms, for many years. And publishing those numbers in audited format also for many years. And I think we are probably the only, at least multilateral, who does this. Can I see the slides again? Sorry. Okay, I'll take them for myself here.
Can you share the slides?
Well, I can take my own slides. I can look at them here. Anyway, so if you see this slide with the two boxes there, we used to have a target between 25 and 35% of total new operations going into climate and environmental action. We have upped that now to 50%. So 50% by 2025 will go into climate action and environmental sustainability projects. The rest is meant to be Paris aligned. And now what does this mean? If we say that something is green, it does not mean that the other lending is brown or somehow bad or unsustainable. It just means that it is not making a substantial improvement. So green is, what we mean by green is substantial improvement. And the rest is either a smaller contribution or neutral, and then what is significantly harmful we don't do. So that one has to keep this in mind. You have plenty of activities in the economy which are neutral. Think about lawyers, music, accounting. They don't make a lot of emissions, so they cannot save much emissions either. Another thing that we have done for a long time is that when we look at the financial viability of our projects that we are asked to finance, we have put a shadow carbon price, which is higher than the market price for many years. We have now just increased that curve, and it's even steeper than it used to be in the past. It is something that lives, so we keep an eye on it every year. Now it's going to 800 euros per ton in 2050, and this is something so we intend to keep this above the market price at all times. So this means that economic case for projects that save carbon emissions is improved, and then it penalizes those which increase emissions respectively. So that is another thing that we have done. Does the audience see my slides now? Okay, now we can go forward. Can we take the next one and then the next one still? And we can still go forward. Okay, and still one more. So then I'll be in synchronization with what I'm talking about. Here, this one. Okay. So what does it mean for our activity? This climate bank? There are certain activities which don't see much change, but then are areas which will see change. Road infrastructure. I mean, we have always financed plenty of roads, for example. So the economic test is adapted. So emissions will be valued at a higher shadow carbon price. But interestingly here, the more you have EVs, electric vehicles on the road, the better it will look. So it depends on the location very much, and the country, and the degree of electrification of transport there. We have, for example, in bioeconomy, we have a meat and dairy where we will see some changes. We will see no expansion into high carbon or areas where biodiversity is threatened. So there's more attention paid to these risks. We have energy intensive industry where we will not finance new capacity, only technology that is low carbon or transitional. Airports, we will not finance new capacity. We will focus on improving the existing capacity. For example, security of airports is very much something that we will still do. And then we can go to my last slide, please. Yes. So what is sort of changing in the DNA of EIB in this risk aspect is it's quite a change for the EIB. We have always been a bank that finances projects and investments, and we have been looking at the environmental case of the project or investment at hand very thoroughly. We have extremely good people who have plenty of experience in this all around the world. So that has been a very, very precise loop through which we have looked at it. But in terms of the entity, the client, we have more looked at them from the point of view of just classical credit analysis. But now what we are doing is we are looking at, we have now started to look at the Paris alignment of not only the projects that we finance, but the entity, the counterpart as a whole, and our portfolio as a whole. So what it means is that we have to look at the rest of the business of our counterparts, not only the one investment that we are financing. And this is so that we can address legitimate concerns from various stakeholders, so that we are not supporting greenwashing by providing finance to some project that somebody does with their, 2% of their capex, and then otherwise continues to engage in activities that can't be reconciled with the Paris Agreement objectives, for example. So it does not mean that we can only engage with clients who are already aligned. It means that we will engage with counterparties who are either aligning already, who are willing to align, and we will help them in this job. This is, of course, most acute for companies that are in high-emitting sectors. It does not mean that we will tell them what to do, tell them that this is your solution. Of course, it is the client's own decision, and they are accountable for it. So it's not for us to tell what to do. But what we do want to see is a strategy that is, first of all, available in the public domain. So it can't be something that CEO has put into the last drawer. It has to be building on regulatory requirements. And we also want to see, especially for corporates, is a midterm targets. So there are 5-year targets, 10-year targets, not just to have one 2050 target. You have no idea how you get there. You intend to do something magical in 2049. This is not what we want to see. And of course, decarbonizing even after 2050 all those plans are very much welcome. So we are not providing the solutions, but we can certainly provide the technical assistance with the expertise that we have in the energy areas. So having said that, while we want to engage in the transition and the transition of our clients, there is, of course, a red line. If there's a counterparty who still wants to continue to invest in high emitting sectors and even establish new long-lived assets there, then even if they do 1 or 2 investments which would look like decarbonizing, I think that is going to be something which is difficult for us to engage. So this transitional plan needs to be serious and take the whole entity into account. So this is something that we have been working on. We published this also in Glasgow, it's also not only from the point of view of seeing the Paris alignment happening, but it is also from the point of view of risk for the EIB, because if we have clients who have a big part of their business, big part of their balance sheet in non-sustainable activities, it is a risk for the bank, for the finance provider, very, very clearly. So this goes very much into the same direction. We need to see the risks. They need to be visible both from the clients, from the banks, so that we can assess the risks. Thank you.
Thank you very much, Eila. And then I would hand over now to Professor Ulf Moslener from the Frankfurt School of Finance, who's a professor at Sustainable Energy Finance, as introduced before. We have now around about 20 minutes left. That's why, Ulf, if you stick to 5 minutes in your reply, that would leave us another 15 minutes for the Q&A session. Thanks.
Thank you, Thomas. Yes, that would be possible, I think. Also, thank you. I think also let's do it without slides, and I'll just make the points, and we then discuss. Right. So essentially, thank you very much for organizing this. I think this is a tremendously relevant and interesting event. I'll also, I think I'll sort of make three claims or hypotheses, which are then substantiate a little bit to kick off a discussion. And in that respect, I'd like to thank Eila very much, and particularly also Frank for making this, how should I say, serious claim to take this topic really very serious. And I would just like to start with the three claims that I'd like to substantiate a bit are: one, we really need to think this as a process, this whole thing. The second point will be, it is key to understand the forward-looking nature of this analysis. And the third would be a bit also from my science perspective, is to tackle the technical challenges. A couple of comments there. So this is also based on discussions we have in Frankfurt around this. Also, there is a Net Zero Banking Alliance Germany actively discussing how to align portfolios with a sort of Paris, with a view to Paris. So first claim, we need to think this as a process. Why? Because it's really very difficult. We'll get into some of the technical challenges, and it will take a while. It has already taken a while. There is going to be more efforts, but really, second reason, really a rough idea on those risks is way better than nothing at all. So, a claim to basically start and be engaged. And there's also many actors involved. It's not just banks and supervisors or regulators of the bank. It's also governments. It is firms that need to communicate about their zero carbon future. So a lot of actors involved. That makes it, also, a process that's going to take time. Now, to the second claim I'd like to make, it is really key to understand the forward-looking analysis. Ellie, you've just also brought that explicitly up in what you just showed about your system at EIB, and that's what I really like to sort of support. And it's of course, I have to say this is not just but ESG, to put it in sloppy terms. But even if we talk, let's like we do here about climate and environmental risks. Even within the E, it's not about the emissions only, that the emissions of the past of a company, but it's really about the consistency of whatever we are doing with that net zero, the path towards net zero emissions. So from a firm perspective, if you want, it's about that going towards net zero in a number of years, and that in a context of your competitiveness within your sector. It's about looking at the sector, even if it's a high emission intensive sector, like cement, for example. It's unlikely that the tricky thing will be to identify those companies who are actually well positioned within such sectors and can do the innovation within a sector. So it's not always a good idea, to cut high emission sectors off of financing. That's not how you do innovation. So, that's the nature of understanding forward-looking analysis. My last claim would be to tackle the technical challenges, which is a bit of more of a not so much disclosure regulated, but a broader perspective on that, a bit related to what I just said. Challenge is a firm level heterogeneity within a sector. Say within the steel industry, there's going to be different players who have different situations and different they have positioned themselves different in the transition that needs to be taken into account, and also into account by a detailed regulation. When it comes to thinking about stress tests, that might also be relevant, at least an improvement on models which are often stopping at the sectoral level. A lot of the issues a bit particular to climate, but also in other areas, are supply chain issue or scope 3 related issues. And that is something, it might not just be sufficient to look at where the biggest part of the of the intermediate good comes from if you want to produce, say, a car, but it could be relevant to look at the lack of some tiny parts might slow down the whole production process. That is a risk, but it's difficult to understand those risks. That's a challenge, a true challenge, I think, and people are working on that. That's an interesting aspect. It's going to evolve over time, right? So it's not yet there. And also one point I wanted to make is about a bit more from a, if you want, science perspective, would be the use of the right climate scenarios, right? To tackle the technical changes here. So what are the right climate scenarios? Very often when I talk to climate scientists, the issue is that they think that institutions are taking sort of core mainstream climate scenarios and then think about standard deviations when to think about an extreme climate scenario. But if you talk to climate scientists, it is really, if you want to identify an extreme or an extreme climate scenario, you just have to use a different scenario, not use the core scenario and deviate and apply some statistics to it, right? So that's a bit of a different technical issue. Again, something maybe for the medium-term future, but some of the technical issues which may become relevant, all of these are areas where you might be able to compete with others in the quality of your risk assessment. So I think, I should leave it like that. So the need to think this really as a process is going to take a while. It is key to understand the forward-looking nature of the analysis and, be ready to tackle the technical challenges, and that's going to take some while. And with that, I'll just shut up and hope for an interesting discussion. Thank you very much.
Thanks very much, Ulf, for this presentation. And looking now at the time, we have a few minutes left, 30 minutes left, 12 minutes left for our Q&A session. I would like to start. I will host this together with Professor Christos Gortsos, who's the president of the academic board of the EBI. But let me start with one question to Frank. Frank, you mentioned in several speeches in the past that many banks, actually most banks, are not only partially aligned with the ECB's expectation on what they should do. Yeah. What, in your experience, are the major gaps in terms of the risk identified and managed and the main issues for that? And does the ECB have appropriate and uniform tools to measure actually climate-related and environmental risks so that there's a comparability? And what about the data in this connection? So can you elaborate a little bit on this topic?
Sure. Thank you very much, Thomas. Maybe 1 minute. Thanks a lot also, Eila and Ulf, for your presentations, which I thought were very thoughtful. And you did extremely well, Ulf, in 5 minutes, I must say, without your slides. But maybe I'll try in half a minute or so to reflect on some of the things you say. It's a process. My answer would be yes, but it better be a fast process, because we know, as I said, referring to the IPCC report, but there are others, that there is great urgency because of climate, but that also means great urgency in upcoming legislation, and banks need to be ready for that legislation. There's great urgency because investors are asking for this information increasingly. Clients are asking for this, so there's a reputational and a litigation angle there as well, and increasingly both physical and transition risks are increasingly manifesting themselves. So there's no time to waste. I didn't hear you say that, by the way, so this is not a straw man, but just to make that point. On the forward-lookingness, couldn't agree more. So this is also why it's so important that banks make transition plans, and not just for the next 30 years, but also what it means in terms of intermediate goals, key performance indicators, and then publicly disclose their progress towards that. I think Eila gave some good examples there. And indeed, that's also one of the reasons why we work, the forward-looking character, why we work with, climate stress tests and scenarios to do just that. And I also agree with you that these scenarios, also because of the tipping point aspects of climate change, need to be rather severe. Now, on the gaps, Thomas, more specifically, I wrote down just, the report that we published today is full of data, of course, but, just some of the things that I thought were very significant. So allow me, that about half of the banks under our direct supervision have few or no concrete action plan to embed C&E risks in their business strategy. So the world around us is changing. There is a COP26. There is all kinds of, there's a climate law of the Union that is now in place for more than half a year. There's all kinds of policies, as we know. And then about half of the banks under our direct supervision have few or no concrete action plans to embed C&E risk in their business strategy. Only a quarter of the institutions have set key indicators to monitor and steer the performance of their different business lines, portfolios and products. No more than a fifth of the banks under our direct supervision have set a key risk indicator for C&E risk in their risk appetite statement. And only about a third of these, so a third of that fifth, have set a concrete limit on these indicators. So I could go on, and again, there's lots of data in this report, and I'm sure you want to allow for more questions. But so it shows that really there is work to be done, and we see examples of banks that have actually done this, so it can be done. Maybe I'll leave it here.
Thank you very much, Frank, for the answer. And then, Christos, maybe you want to ask the next question.
Thank you very much, Thomas, and thanks to all three speakers for these great and clear presentations. Frank, if you allow me, two questions. The first one on the international dimension, your expectations in the ECB with regard to the banks under your remit have apparently, you were bold on that, not been fully met, I would add, yet at least, But what about the rest of the world? I mean, you are discussing these issues at the Basel Committee, in the Financial Stability Board, in your network. Do you believe, point number one, that some other banks in other regions have more progressed towards that end? And second, whether we have some kind of competitive equality with regard to rules adopted in other jurisdictions? And my second very brief question, if you allow me, you have focused, and correctly so, I believe, on Pillar 3. But now we have the banking package of 2021, which I understand will also step into the Pillar 2, on the SREP assessment. Do you think it would be already mature to take a stance on that? Thank you very much.
Thank you very much, Christos, for these questions. Well, maybe on the international, to start with your first question first, on the international dimension. You already referred to that, Thomas, in the very beginning. The Central Banks and Supervisors Network for Greening the Financial System started a little over 4 years ago with, I think at the time, 8, and then we grew fast to like 12 members. Now it's 108 and 17 observers, among which the IMF and many of the big international institutions. So 108 central banks and supervisors around the world. That means that practically in all relevant jurisdictions, the supervisors, let me just focus on that now, are aware of this information that we share, are taking steps, making sure that the time to market, if you like, of a good idea that comes up somewhere in that broad network, is shortened very considerably. So, 4 years ago, a good idea in one of the member central banks, before it reached, some other central bank supervisor, before it reached their supervisory expectations, their planning, it would have been a lot of time. Now everyone reads these reports, and the next day they can take that into consideration. So I think, and all that is to say that the awareness, the kind of activities, the stress test technologies that are being used are increasingly being used around the world, and the time lag between those at the very forefront and those lagging slightly behind is not to be measured in decades, it's not to be measured in many years, it's maybe 1, maybe 2 years, but not much more than that, if at all. So there I would say the world is moving. Sometimes, one jurisdiction will be a little bit ahead of the other, but not much. Now, the Basel Committee work there is helping, I think, greatly as well. Work is being done on all 3 pillars of the network, of the framework, I should say. And as you might know, also there, supervisory principles, expectations have been published, and a huge amount of reactions have been sent in. All these are being processed later this year. A final version of these will come out, and that's a very tangible aspect of this international cooperation, also in the Basel Committee, which of course, unlike the NGFS, is not in the end, a informal network. Now, on SREP, very good question. I think the way I look at this, and let me now just talk for the ECB. This is the year 2022 in which we really integrate climate and environmental, and I always make that point as well, climate and environmental related risk in our day-to-day supervision. It's no longer just the work being done by some kind of a project group within the broader, no, this is being done now on the basis of our joint supervisory team, which is the teams, which is, the teams that do the daily, day-to-day interaction with the banks that they supervise. So it's becoming an integral part of our dialogue with the banks. This year we do the thematic review, which is a fully fledged supervisory review. We will give feedback to the banks. We do the climate stress test, and the results of both the thematic review and the climate stress test will feed in these threats. And this is relevant. It will, in a qualitative sense, be communicated to the banks. It might also have indirect effects by the scores under the Pillar 2, changing the scores. For example, if you see that the certain governance is really substandard, the score on governance will be lower. This will affect and might then also have an indirect impact on the minimum capital requirements. So yes, I would say in terms of SREP, all the things that we have been doing in the last couple of years, the supervisory expectations, the self-assessments, the stress test, the thematic review, the on-sites that we do, it all feeds into the SREP. It will no longer go away. We treat climate and environmental related risks just like any other risk.
Thank you very much. Thank you.
Thank you.
Frank, knowing that you need to leave very shortly this call, just one last question to you. You mentioned in interviews that the ECB will not insist that banks get rid of climate risk, but they basically manage it, disclose it, yeah? So does it concretely mean that you will not ask banks to divest the so-called brown industries? And then also feeding in a question from the audience in the Q&A tool, what kind of enforcement will the ECB undertake in relation to all of these guidelines and demands that you have been highlighting right now?
Right. Very good questions. On the first one, it's of course a very fine line. We are not bankers. We are not the private sector. We do not sit on the chairs of the boards of the banks, and neither should we. That's not our role. So others need to make investment decisions. Others need to make climate policies. We are climate policy takers. What we are on earth for is to make sure that banks manage all their material risks. And we have come to understand, without any doubt, that climate and environmental risks are material. They translate into financial risk, they translate into all the existing risk categories, and they are material and they must be managed. Now, more broadly, abstracting for 1 second from climate, more generally, banks are about risk taking. They are about credit risk taking. So we cannot, and we have not over the decades, never said that banks should not take any risks. They should take risks in a measured way, in a mitigated way, in a way that is in line with their risk appetite and their risk management capabilities should be in line with that, and their capital should be in line with that. Now, same here. So we are not telling banks that they should divest. We are saying to banks, you better pay attention to the fact that this world is changing, and this world is changing fast. This world is becoming increasingly a Paris-compatible world, and you will have to be profitable in that Paris-compatible world. How are you going to do this? How is your strategy going to be aligned with this? Not just in 30 years, but also in the next years. How are you going to report on that? How are you going to make sure that your investors have the tools and the information to make sure that you are actually doing that? So that is what we do, which falls short of saying you should invest here, you should divest here. But it does say you better know what you're really doing, you better manage these material risks, and you better publish and be transparent and disclose. On what we and then very shortly, and then indeed I have to apologize that I need to go. So I would have loved to, just like Eila, to spend all day here, but I unfortunately I cannot. But the last question is important as well. What can we do? As I said before, the thematic review, for example, is what we call a fully fledged supervisory review. That means that all the tools that on the basis of the the capital requirements directive, the capital requirements regulation are to our disposal, we can use. So this goes from from regulatory or supervisory dialogue to more formal actions. And as I said also, we will be looking in the under the pillar to the scores that might have an indirect effect on minimum capital requirements. And ultimately, I've said, so that is not in the books for this year, but ultimately in the coming years, we also have, as with all relevant risks, the possibility to set pillar 2 capital requirement.
So I wanted to ask also Eila one question in relation to, let's say, the EIB's experience with realigning portfolios, setting new risk appetites, developing mitigation strategies, adjusting in qualitative credit criteria, in the context of the Paris Agreement. What is your experience, how it works? And I mean, we have heard that other banks will have to do the same thing, of course. This is what the expectation of the ECB is. So what is, let's say, your experience from basically being a step ahead already in this process?
Well, for a public bank, I think it's a slightly different thing, because we get, for example, our capital from the governments. So it's not an infinite resource which comes in if we just make a good return on investment. We are supposed to do the public good. So for us, this transition has started already like 15 years ago. So it has not been quite as rapid a change as it may have been for some commercial banks. And because our criteria, what we do, are slightly different. We don't go after the profit maximization at all. It's with the public good, as I said. So, but of course, it has meant building quite an elaborate framework on how to assess the risk for clients, for projects, for all the aspects, not just looking at one thing, but taking like a 360-degree review on things. So it has been quite a process, and it's still ongoing. Like I said, for example, this is quite new for us, that we look at the whole business, the whole balance sheet of our clients from this point of view, from the Paris alignment point of view, not just the project. So we are still building, but I think it has been maybe in the last few years a little bit less painful for us because we did not come from such a distant place. We started this a long time ago.
Ulf, can I ask you a question, please?
Always.
Yeah. Your first point was that, correctly, we are in the middle of a process, correct? Which is kind of limited by specific regulatory and supervisory constraints, yeah, as we have heard. In your view, what is the expected time in which you would see that we would reach a steady state with regard to the transition to a new situation? Could you kind of estimate that? Because at the same time, it's a very dynamic process, correct?
Yes. Yeah, I think it is actually. So the steady, as a physicist, I love the steady state as an economist, by the way, too. But this, I think the challenge that we're seeing here is that we are in a transition, which is like a structural change process, where the whole challenge of this is closely related to the fact that this is not about a steady state, but rather about sort of moving the steady state, if you want. So you want to have a stable transition. That's the challenge. And I would say that the different so the time horizon for getting it all done is very, very long because there's so many challenges here. I would rather consider this that the different challenges will need to be met on different timescales. A bit along the line, what Frank has been emphasizing is that in the very short time, we need a minimum degree of transparency on the issues. And as time goes on, we can be more ambitious on the level of detail that we are able to measure in a way. So I would say the time horizon for immediate first steps of some transparency on, say, climate and environmental risk disclosures, that time horizon should be very, very short. But that's also why I highlighted the longer term challenge. And he also said, okay, if we want to think about pillar 2, own capital requirement adjustments, that's maybe a bit of a longer time horizon. And really understanding sort of physical risk on assets in a better way, that might take even more time. So I think it's this synchronized transition that needs to go on. It needs to be synchronized to some extent between the different actors, like the supervisory authorities and the banks, and that makes some of the challenges. And also, if I may say, from a German perspective, it's also there needs. My impression is that banks are also, some are more and some are less willing to really take the lead, if you want, on moving their systems forward and think like that, such that I also would say that sort of transparent ambitions formulated by the regulator, in my view, are helpful to synchronize this moving forward. Process, yes. Timescales, very different, but the synchronization, I think, is an important ingredient to stability here.
Okay.
Thank you very much, Ulf and Eila, for your answers. We are now a little bit over time, but I think looking at the audience, there was still a lot of questions that have been coming up. We also have a few questions in the Q&A tool, which I will pass on to the discussants and to Frank. But thanks very much for participating in this very interesting policy series on a very up-to-date topic. I hope you enjoyed it, and we will see each other again, hopefully, at one of our next series. Thanks very much, Eila, and to Ulf for participating. Christos, thanks for co-hosting this with me, and then all have a good day. Bye-bye.